If you are currently, or maybe you've ever been, a renter, you probably know the feeling. Securing an apartment can feel like running a financial gauntlet.
Oh, absolutely. And it seems more stressful than ever right now.
Yeah, the scale of the financial pressure, I mean, it's just huge.
It really is. When you look at the numbers, the amount of debt tied up in the rental system is staggering. PolicyLink estimates nationwide, we're talking upwards of $20 billion in total rent debt.
20 billion, wow.
And get this, about 14% of that huge number is already in arrears, so debt that's currently owed.
And that debt, it doesn't just materialize, right? It builds up. Rising rents, sure, but also these really aggressive screening processes and just a confusing mess of hidden charges.
Exactly. So that's what we're diving into today. We want to understand sort of two key playbooks. First, the landlord's playbook for managing their risk.
Okay.
And second, your playbook for navigating all those financial hurdles, the fees, the potential traps.
Right. Our goal here is to give you the knowledge you need to understand how landlords assess risk, how they manage it, and crucially, how you can defend yourself against, well, predatory fees and these unexpected liability situations.
Think of this as the essential shortcut to understanding the fine print.
Okay, let's dive in. Where does it all start? The landlord side, the screening process. How do they try to avoid defaults right from the beginning?
It all starts with that initial tenant screening. Landlords are really focused, laser focused sometimes, on spotting red flags, things that suggest financial instability or maybe high turnover.
And they rely on pretty clear criteria for that.
Generally, yes. Crystal clear criteria, ideally.
So what are some of those big warning signs they look for? Things that maybe aren't obvious to someone applying.
Okay, one of the biggest is what you might call a choppy rental history, pattern of moving every 2 to 6 months.
Right, signals instability or maybe issues at past places.
Exactly. Another classic red flag, and this one's interesting, is offering a big chunk of rent up front, like several months, specifically to bypass the normal application steps.
Trying to skip the checks.
Precisely. It might look generous, but it could be masking bad credit, maybe poor references, or even a criminal history that a proper check would uncover.
But wait, doesn't offering advanced rent sometimes just mean someone's maybe, liquid financially but has a temporary blip on their credit? Or maybe works freelance. Doesn't that system kind of favor traditional W-2 employees?
It often does, yeah. It can definitely put freelancers or people with non-traditional income streams at a disadvantage. That's why landlords ideally look for a combination of factors. Good credit history is big, but there should be nuance.
Nuanced out.
Well, looking at how recent any delinquencies are and how frequent, not just the score itself. And stable employment is huge, not just for paying rent now, but it's often seen as the best predictor of whether someone will renew their lease.
That makes sense. And background checks, of course. Though that varies a bit by location, right?
It does. Clean background checks are standard, but some places have restrictions. I think there was a county in California, for example, that banned criminal checks entirely for rental applications. So local laws matter.
Okay, and there's this emerging practice that seems really important. Landlords reporting on-time rent payments to credit bureaus. What's the deal with that?
Yeah, this is a really interesting development. I think it's potentially great for both sides, actually.
No so.
Well, it incentivizes tenants to pay on time because doing so actively builds their credit history. This is especially good for, say, younger renters or anyone trying to establish credit.
Okay, yeah, I can see that.
And for future landlords, it gives a much clearer, more accurate picture of someone's payment reliability compared to traditional checks that mostly just flag problems like debt and late payments.
Is this common yet? Can renters actually ask for this, or is it still pretty rare?
It's becoming less rare. You see it more with the larger property management companies. They see it as a benefit they can offer residents.
A selling point, maybe?
Exactly. And the data suggests that when residents know their rent payments are being reported, they tend to be more diligent about paying on time. It's a strong incentive, and it doesn't cost the resident anything extra.
So screening is step one.
Yeah.
But what happens if there's a potential issue flagged during screening, but the landlord still might want to rent to the person? That's where guarantees come in.
Correct. Lease guarantees are a major tool in their risk management toolkit. Think of it like a surety bond. The renter pays for it, and it protects the landlord if that resident defaults on the rent.
Okay, so it lists landlords bring in tenants who might not meet every single traditional requirement on paper. Who typically uses these?
We see it a lot with self-employed folks. They might meet the income requirements easily, but they don't have the standard pay stubs.
Right, the paper trail is different.
Exactly. Or international renters, like students. Maybe their income or savings are held overseas, making it tough to verify through standard U.S. credit checks.
And for the landlord, it's all upside.
Pretty much. It opens up a wider pool of potential renters, which means fewer vacancies, faster leasing times, and ultimately lower risk for them. And importantly, it's usually at zero cost to the landlord because the prospective renter is the one paying the fee for that guarantee policy.
Okay, that makes sense from the landlord's risk perspective. Now let's shift gears a bit from risk mitigation to liability exposure for the people involved, maybe family or friends. This brings us to a really critical point, the difference between a cosigner and a guarantor.
Yes, this distinction is absolutely paramount. It fundamentally changes your liability when it kicks in and the risk to your own credit score. It's something people often confuse.
Okay, break it down for us. What exactly is a cosigner agreeing to when they sign?
A cosigner signs the lease right alongside the main renter. They are legally responsible for the rent and utilities right from the start, from day one.
So they basically co-own the debt immediately.
That's a good way to put it, yes. If the primary tenant misses even one payment, the cosigner is instantly responsible for covering it. And crucially, that missed payment can immediately damage the cosigner's credit score.
Wow, okay, so they're like a co-tenant financially, just without the keys. Now, how is a guarantor different?
Very different, especially in terms of timing and credit impact. A guarantor agrees to pay the debt only if the tenant completely fails to pay what they owe. Usually this means after the tenant has defaulted entirely, fallen significantly behind.
So not immediately responsible for the first missed payment.
Just generally, no. They're a backstop for total default. And here's a key point. The guarantee itself, the agreement, is typically not registered on the guarantor's credit file initially.
Okay.
It usually only impacts their credit if the landlord actually has to pursue legal action against the guarantor specifically, like getting a court judgment for the unpaid debt.
That is a massive difference in terms of credit risk. Huge.
Colossal. But even being a guarantor, while maybe less immediately risky than co-signing, still carries significant legal vulnerabilities. You need to be careful.
And the sources mentioned potential issues with paperwork.
Absolutely. These guarantee agreements can be complex legally. For example, Shelter points out that the guarantor isn't technically obliged to pay until the landlord has specifically asked them to.
Okay.
And the agreements can sometimes be challenged if the paperwork wasn't done right. Like maybe it was a joint guarantee and not all the named guarantors actually signed it. Or, and this is a common one, if the guarantee document was signed after the main tenancy agreement was already in place.
After. Why does that matter?
Because unless it was executed with the formality of a legal deed in that situation, it might not be considered legally binding. The timing matters. Also, the guarantee usually only covers the initial fixed term of the tenancy.
So if the lease automatically rolls over to month,
Exactly. If it converts to a periodic or month-to-month tenancy, the guarantor typically needs to agree in writing to extend their guarantee to cover that new period. If they don't explicitly agree to that variation, their original obligation might end right there.
So let's say you guarantee your kids 1-year student lease. They stay on for a second year, just paying month to month without a new lease or guarantee form. If they default in year 2, the landlord might have trouble coming after you based on that original year 1 guarantee.
Precisely. It could be challengeable. Poorly executed or outdated paperwork is definitely a vulnerability for landlords trying to enforce these later on.
The takeaway seems clear. Know exactly what you signed and when you signed it. Okay, so guarantees and co-signers protect landlords against big losses like total default. But let's talk about the smaller, maybe more insidious ways revenue gets extracted, what's being called the junk fee epidemic.
Yes, the sources we looked at, especially reports from legal advocates across the country, paint a pretty grim picture here. These fees, they seem small individually sometimes, but they add up. They push renters closer to the financial edge, and importantly, unpaid fees often get treated as rental debt.
Which then leads to negative credit marks, collection attempts,
Yeah.
the whole cycle.
Exactly. And it's widespread. One survey found that literally 0 respondents, these are legal aid lawyers working with tenants, reported seeing rental agreements with absolutely no fees charged beyond rent and security deposit. Fees are everywhere.
Okay, let's start at the beginning again, the application process itself. We hear about application fees ranging wildly, like $25, maybe up to $350. What's the problem there, beyond just the cost?
The potential for abuse. It stops being just about covering the cost of a background check and becomes a revenue stream.
How so?
Well, some landlords might keep accepting applications and the fees that come with them long after they already have plenty of qualified candidates for a single apartment.
So they know they're probably not going to rent to applicant number 25, but they take the $50 fee anyway.
It certainly appears that way sometimes. The justification is usually processing costs, but when you're collecting fees from dozens of people for one spot, you have to question if the intent is really just cost recovery, or if it's become about maximizing fee income, regardless of the applicant's actual chance or the unit's availability.
Okay, that's up front. Then you have the fees that kick in when you're already living there, maybe struggling.
Yeah.
Late fees.
Yeah, these are almost universal. Something like 87% of advocates reported seeing them regularly, and they're often described as punitive, not really reflecting the landlord's actual administrative cost for a late payment.
Punitive how? Like excessive amounts?
Often, yes. You see things like daily charges piling up maybe $5, $10, even $25 per day that rent is late. This can make a slightly late payment spiral into a huge debt very quickly. And sometimes these fees even violate state-specific caps on late charges, like Maryland's 5% cap.
Wow. But it's not just application and late fees, right? The sources talk about all these other hidden, often recurring, add-on charges, especially around utilities.
Yes, that's a big one. Many larger buildings especially use something called a ratio utility billing system, or RUBS.
RUBS, what's that?
It basically means the building isn't sub-metered for each unit, so you're not paying based on your actual water or gas usage. Instead, the building's total bill is divided up among tenants based on some formula, maybe apartment size, maybe a number of occupants.
So you can be conserving water like crazy, but your bill is based on the building average or your square footage.
Pretty much. And then on top of that allocated utility cost, you often get hit with extra service fees or processing fees, especially if they use a third-party billing company like Conversely, which is common. It makes your utility costs less transparent and often adds charges you wouldn't have if billed directly.
Okay, so opaque utility billing plus fees. What else? I think the term administrative fees came up.
Yeah, these vague, sort of unspecified charges, they might be monthly, maybe $10 or $20 just tacked onto your rent for admin. Or sometimes it's a one-time move-in fee, maybe $175 or more, for processing paperwork in addition to the application fee you already paid.
Just for existing.
It can feel like that. And don't forget convenience fees.
Ah, the fee for paying your bill.
Exactly. You get charged extra for paying your rent online, even if the online portal is the only way the landlord allows you to pay. Or sometimes, bizarrely, even for paying in person. One source mentioned a $15 fee in Texas just to hand over a check physically.
You pay a fee for the convenience of them not having to process a check.
Yeah.
That's inventive.
Okay, let's talk about the really unavoidable stuff. The fees that seem designed purely to protect the landlord, often at the tenant's expense, like mandatory insurance fees.
Right. This is a crucial one to understand. Landlords increasingly require tenants to have liability insurance, but often the policy they mandate only covers damage to the landlord's property, not the tenant's belongings. Okay, so it protects the landlord if, say, you accidentally start a kitchen fire.
Exactly. But if you fail to get this insurance yourself and provide proof, they don't just remind you. They often impose what's called force-placed insurance.
And what's the catch with force-placed insurance? Is it just like a regular policy?
Oh, no. It's typically much more expensive than a standard renter's liability policy you could get on your own. A standard policy might run you $10, maybe $20 a month, but the sources cited examples of landlords charging tenants up to $75 a month for this forced-placed coverage.
$75 a month.
Yeah, so it functions less like simple coverage and more like a hefty monthly penalty for non-compliance.
Okay, that's a big one. What about smaller but maybe equally irritating fees, like notice fees?
Yes. Charging a fee, often around $50, just for printing and posting a notice, like a 3-day notice to pay rent or vacate.
Wait, they charge you a fee to deliver a notice telling you you owe them money? Or possibly that you have to leave, even if the notice itself might be legally required or maybe even invalid?
That's exactly what advocates report seeing. It feels less like recovering a cost and, frankly, more like adding insult to injury or even a form of harassment.
And then there's the truly, shall we say, questionable fee, valet trash.
Ah, yes, the mandatory monthly valet trash fee, usually somewhere between $35 and $55 a month.
For someone to take your trash out for you.
Theoretically, but the advocates reporting on this frequently stated that the service often does not actually exist in practice.
Hold on, people are being charged $35 to $55 a month, mandatorily, for a trash service that might not even be happening. How does that work? Are they just collecting the fee?
Often, yes, or the service is extremely sporadic, unreliable, maybe they miss pickups constantly, but the fee is mandatory in the lease regardless of whether you want it, use it, or even if the service is actually provided reliably. It's just another unavoidable monthly charge tacked onto the rent.
That's pretty brazen.
Yeah.
And it leads us to another area where things get murky. Security deposits, or rather, the things replacing them.
Exactly. Landlords are increasingly pushing these non-refundable deposit replacement products. You might see names like Jetty or Lease Lock.
Okay, how do those work?
Instead of paying a large refundable security deposit up front, the tenant pays a smaller, non-refundable fee, maybe monthly or as a one-time charge. This fee buys an insurance policy or bond that covers the landlord for damages or unpaid rent, up to a certain limit.
So the tenant pays the fee.
But the coverage is entirely for the landlord's benefit. The tenant gets absolutely none of that money back when they move out, even if they leave the place spotless.
So it's basically the landlord shifting the cost of their insurance onto the tenant and making it non-refundable.
That's a fair assessment, and critics argue it's a way to sidestep all the state laws that carefully regulate how traditional refundable security deposits must be handled and returned.
Which brings us nicely to our final segment, traditional security deposits. Because those are refundable and legally they belong to the tenant, right?
That is the absolute key distinction. If you pay a traditional security deposit, that money is still legally yours. The landlord is just holding it as security during your tenancy.
And there are strict rules about them. Let's use California as an example, since it often has strong tenant protections.
Right. California law is pretty clear. Deposits are refundable. And there are limits on how much landlords can charge. In fact, a new law effective July 1st, 2024, limits security deposits to just 1 month's rent for most landlords in California.
1 month's rent max. That's a big change from the old 2 or 3 months rent standard.
It is a significant change aimed at reducing the upfront financial burden of moving. And the law is also very specific about what landlords can deduct from that deposit when you move out. They can't just invent charges.
Okay, what are the allowed deductions?
It's generally limited to 4 things. 1, any past due rent you still owe. 2, repairing damage that the tenant caused, but, and this is critical, it specifically excludes normal, ordinary wear and tear.
So they can't charge you for, like, carpets getting slightly worn.
Correct. That's wear and tear. 3, cleaning costs necessary to return the unit to the same level of cleanliness it was at when you moved in.
Okay, back to the original condition.
Exactly. And 4, replacing the landlord's personal property, like furniture, but only if the lease specifically allows for that and outlines the terms. They can't charge you for damage that was already there, which is why move-in checklists are so important.
And tenants have rights around the move-out process too, right?
Right.
Something about an inspection.
Yes, a really crucial right is the pre-move-out inspection. In California, you have the right to request this inspection within the last 2 weeks before you vacate.
What's the point of that?
It gives you a chance to walk through the unit with the landlord or their agent, identify any potential issues that could lead to deductions, and then you have the opportunity to fix those things yourself before you move out, potentially avoiding the deduction altogether.
Ah, proactive damage control. Smart.
Definitely. Then, after you've fully moved out, the landlord has a specific deadline by law. In California, it's 21 calendar days to do 2 things. Provide you with a detailed, itemized statement explaining any deductions they made, and return the remaining balance of your deposit.
21 days in California. But that timeline isn't the same everywhere, is it?
Not at all. The statutory deadlines for landlords to return security deposits are honestly all over the map across the U.S.
Well, what kind of range are we talking?
You've got states like Hawaii, New York, and Alaska requiring the deposit back within just 14 days. Pretty quick.
Okay.
But then you look at states like Alabama, Arkansas, and West Virginia, and they give landlords a full 60 days.
60 days. 2 months. Wow.
Yeah, it's a huge difference. 30 days seems to be the most common time frame across states, but the wide variation really highlights why it's absolutely essential for you as a renter to check the specific security deposit laws for your state. You can't assume it's the same everywhere.
Absolutely. Okay, so wrapping this up, we've covered a lot of ground. From the high-stakes screening process and how landlords try to gauge risk,
to the really vital legal distinction between being a cosigner versus a guarantor and the different liabilities involved.
and then wading through that minefield of junk fees, application fees, late fees, admin fees, utility billing tricks, valet trash, the list goes on.
It really does. And I think the core takeaway is that knowledge truly is your primary defense in today's rental market. If you understand how screening works, if you know what fees are legitimate versus questionable, if you understand your liability when signing or guaranteeing a lease, and if you know your rights regarding security deposit,
You're just in a much stronger position.
exactly, you stand a much better chance of navigating the process without falling into financial traps or facing unexpected costs. It helps you maintain your financial stability.
And if we pull back and look at the bigger picture, this whole system, especially the junk fee part, it has some really significant long-term consequences, doesn't it?
It really does. Because, as we discussed, these junk fees can so easily turn into rental debt. And that rental debt leads to negative credit reporting, collection actions. It becomes a major barrier,
A barrier to what?
a barrier to accessing future housing. It creates this negative cycle, and the data indicates this disproportionately impacts renters of color. One source mentioned that 63% of people carrying rent arrears are people of color.
Wow.
So this lack of transparency, the way these often punitive fees are piled on, it's not just an individual financial headache. It contributes to a broader cycle of financial instability that hits certain communities harder and ultimately affects the wider economy.
It definitely makes you think. What's the real cost to society when finding stable housing, even when you can afford the advertised rent, becomes such a complex and risky financial gamble? Something to consider. Next time you're navigating the rental market, just remember, understanding where the landlord's risk management ends and your potential liability begins. That's probably the best leverage you have.